Okay,
Now
I
it is
just got it.
recording.
Okay. So thanks for reminding that. So today's session is a 45-minute session and then a 15 minutes Q&A. So this is based on feedback from many of our friends from the last few meetings. And so thanks, Manish, for really sharing your experience, and also you're preparing a lot of things and then sharing with our friends, and also answering many of the Q&A. And we already initiated that poll EV, and I saw a few questions there, and some votings on the question also. So please continue. If you have questions, you can put in there and vote the questions also. Maybe finally we use the poll EV to answer those questions. And you can use the reaction buttons also to just express your views, and use the chat box also if you want to share your thoughts. Okay, Manish, all for you.
Okay, that's wonderful. Yeah. Thank you, Bala, for putting up this session and moderating it. And basically, let me share my screen, and just 1 second. We can start here. Okay, you have to give me right for sharing. It seems the host disable participant screen sharing.
Yes, Bala, near the screen share button, there should be a small arrow to click allow participant to share.
Yeah.
Yes, now I can share. So you can see my screen?
Yeah.
Yes, Manish. Yes.
So it is my slide here, right?
Yeah, that's right.
Yes.
Okay, wonderful. Let me go to slides show moment. Yeah. So okay, so here like I chose this topic, okay, and because this is basically like generally like I'm taking it from my last last discussion we had, that the most important thing for people to be in a stock market is to basically understand themselves. Okay, so they got to figure out what they are and what style suits that, then they can figure out what is the strategy they can come and play, and then what what they should do or what they should not do. Okay, so before going into that, I just want to use this so that is why the topic is type of participants in stock market. So I've tried to simplify it as much as possible, so that like people who live here, they live here with some messages, and they can take some action, action from these. Okay, this is the disclaimer that I am not a registered investment advisor, neither I'm an expert, and I will refrain from giving stock tips and whatever. Even if we talk about any stocks, it would be only for learning purposes. So in my observation, what I see, that there are these type of like if you, so here the participant I define anyone who buys or sells stocks on the exchange. So basically, if somebody buys a mutual fund or something, I'm not putting them in participant because I'm thinking that they're going in this route. Okay, so somebody who is directly buying or selling, I'm putting them as a participant. So what I see, the participants right now, they are like two types. One is individual, one is institutional, and other is individual. And in institutional, you will find a lot of people who are analysts, and then they give advice. Okay, they themselves also buy, but their main work is to give advice. There are fund managers, there are traders, and there are principals. So principals are basically the people who invest their own money, but they do more like they have their own company, or they have their family company, and then the family company has appointed them to invest their money. So basically they don't take the somebody else money. That's why they are not fund managers. So they are similar to fund managers, but they just invest their own money or their family or their company money. So on the individual side, like us, so like this thing is basically just for like, because these people, the participant are the major part of the market, especially in India, right? DII and FIIs, they are all in this one, and then as well as the promoters can also be considered in this, because they may have their principals who are doing a thing for them. Then we are in this category. So what I find, like individual investors, they are like three main categories. I can divide them. One is like bookworms kind of category, and second type would be like bird hunters kind of category, and third would be like wild hunters. So this is like not to use any like negative connotation here, right? But try to understand what is there so that we can learn from each and see where we are, right? So the objective is what type of participant we are. We have to understand that. Okay. So if you see like this is the gun, right? And if you want to use the gun, you need to basically know what type of gun you want to do, where you want to shoot, and what are do's and don'ts of the gun. And then you have to go for license. What is the process of obtaining the license? Is there any training involved? All that, right? So these kind of people, bookworms, they basically spend a lot of time in this part of the thing. So if let's say that investing is like just like hunting, right? So there are people who spend a lot of time in just this part. So this category of people, they read a lot, focus on news flows, do a lot of research, and they make processes also. They say, okay, I will do this and then this, and basically when the stock reaches here, then I will do that. And but when I see them, they take too much time in getting started. Okay. So like I know some people like whom I have been talking to like 6 7 years 8 years, and even today if I go to them, they either have not invested, or even if they have invested, they have invested very little money, right? And let's say they have like 5 crore, but they have invested like 5 lakh rupees, something like that. So and it is not like they're not interested. They are reading a lot of books. They are spending a lot of time on TV, listening to the news, but still somehow they are not getting involved in this. like like I would say that is spending time, but is still not able to reap the benefit, because just not able to do. And when you say, but why, just get started, and then they will say, Manish, I will first figure out the thing, and then only I will get started. You know my style, and like that kind of justification they have. Like, I have to know all the risk first before I put my bet in, and whatnot. Like you can find quite a few or excuses from them, right? So but like, do not take this bookworm as negative connotation. uh, One thing we should know, that that is not a wrong thing, right? Because even what type of investor you are, you have to read books, you have to understand the news, and you have to filter the news. That is just part of the game. But where here the basically the learning is that this particular people just stick to that and don't move. So reading the books and reading the news is basically necessary requirement, not sufficient, right? So you move beyond that. And that is where this category doesn't make enough money in the market, right? So moving to the next category is like this one, like bird hunters. So if you see a lot of people, in recently came in the stock market, and if you see that they started working from even last year. And I know a lot of people uh, who started recently, or even not recently, even long back. They are in this category. So what is the difference in the two? They like to shoot birds. Okay. So, and hands are very itchy all the time. They cannot sit quiet, right? And they, and their accounting, they are not careful, right? So initially I was in this category, right? As soon as I came in market, and then I just want to make trades, and oh, 5% 10% gain and sell, right? And let's say that I did not buy anything for in one day, and then, oh man, I did not do anything, like that kind of thing, and then I am very itchy to do something. Right? So, but where the learning I had, that when I did the analysis, okay, like for last 6 months, how much money I made. So in my brain I was thinking I'm making a lot of money, but when I put my things on the Excel sheet, I found out I was not making much money. It's like in fact the trades which were giving me losses were bigger than the trades which were making money for me. So that is another thing. So many time cost of bullets is more than the meat they get, right? So because they are just spraying bullets everywhere, not able to kill, right? And this category people also to have this license, which means they also read books, they also have skills to do the to do the trades, and they also listen to the news, but they do less research, right? Means like they are more a skill focused guy, less of research guy. And sometimes they follow lead from anyone, like, oh, somebody say, oh, bird is on the roof, and then they just go. Newspaper says, oh, buy this stock, they just go and buy. Somebody, oh, bird is on the street, then they get out of the house and go and from the street try to shoot there. Right? So that is their basically style. And sometimes they get bullets on the borrowed money, so that is leverage kind of thing. So if they get like is like if somebody gets more bullets for same money, then they spend it carelessly, and if their accuracy is not good, ultimately it can be worse than just commonly shooting without borrowed bullets. So this category would be more like a trader category, right? Then the third category is this, the people who go and hunt in the wild, and the one they target big elephants, right? So if you see, what do? They also have license of gun and skills to kill, right? So that is like this first thing is in this one also. It is the baseline kind of thing. They read the maps, okay? They spend time in jungle. So even if when they are not killing, they spend time in jungle. Then wait for the hunting season to come. So they are not hunting every day. It's like they wait for some season to come, okay? When they know when the animals are out, right? They know where to hunt for better results, right? A good hunter always knows, like, if he has to catch an elephant, where he will catch, right? And where is higher likelihood for him to find them, right? They know where he can find leopards, where he can find tigers, right? Can follow the footprints of the target hunt for years, right? So if you look at some of these people, the big hunters like Warren Buffett, they followed the company for like 10 years, right? And but he still did not trigger buy on it. But when time came, they buy it, right? So that is the quality. So that is where like if you say you will see Warren Buffett telling that for a few years he doesn't do anything, and then suddenly he will go and invest 20% of his money, right? So that is the big quality of a big hunter, that they can sit tight for very long. And there is a story that there was a target company which Warren Buffett wanted to buy, and he waited that for 5 years. And when the guy came, okay, I'm ready to sell, then he said, okay, just give me these 5 parameters. And then he just gave those 5 parameters, that information, for 5 years. In half an hour he made the decision. And very big size opportunity. So they can hold the trigger for days. Just aim there. Just keep holding the trigger, aim, and when the time comes, find courage and shoot it, right? So that is the big time investor category. Okay, so there is nothing right or wrong. We have to see which one works for us, right? But there is definitely like benefits and basically lesser benefits, or you can say that benefits on each sides. Like for example, in this one, um, people can get meat probably every other day, right? But in this one, it may not happen. There are times when I had negative years for like 3 years. I had negative years consequently, right? And so that means I was not making money then, right? But in this one, sometimes even you can give sell call, and then you can make some money, and then uh, like you can make money out of trade, right? So if somebody has to depend his livelihood totally on this, uh, probably like this they have to do, uh, like even if they do not want to do. So that is this benefit. Is like it has a lot of there is a higher opportunity of recurring money coming out of it. So anybody has any question here? Okay, so if not, then I will move on. Yeah. Somebody open his mic? No. Yeah.
No, sir, no.
Yeah. Okay, so key points to discuss. So what I'm doing is I'm putting some points which are which basically can be pertaining to trading, can be pertaining to investing, just making them as a point of discussion. Okay. So one thing we have to remember, that success and failure in a stock market is more related to duration than a skill. Okay, and it is very surprising because a lot of people spend a lot of effort and focus on a skill, right? Where probably if they would have just started early, they would have made more money, right? So I think somebody in Valam group or some other investment group sent me this one, right? And this one is like 100-year data from S&P 500. And if you see like this data, what do you see? That if you invest for a day, there is 56% chance that you will make money, right? 44% you will not make money, right? If you invest for a year, that becomes 75%. If you invest for 5 years, it becomes 88%. If you invest for 10 years, 95, and 20 years, it's 100% chance that you will make money, right? And so if you look at this, time duration is just like so highly correlated to the time you spend in the market, right? So if you see the message coming here, if somebody has invested in US markets for more than 20 years, no matter how dumb he was, he would have made money. He would have made money, right? So so this message is very important, that 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 time in the market is more important than timing of the market. A lot of people try to figure out, oh, how to time it, how to time it. It may not be necessarily like, so let's say, for example, there is a stock at 100 rupees, and then I'm thinking, oh, I will time it, and then, okay, what is the best price I can get? Oh, maybe I can get it for 80. Okay, so you buy 20% lower. Instead of that, you buy at 100. And if you invest, if it goes to like 100 to 80 and then goes back to like 1000, so on 80 rupees you made 1000, or 100 you made 1000, doesn't matter much, right? And what happens if you try to time, then it may happen that it may never go to 80, and then you never get invested, and then you jump into the first category where you are researching but not able to invest. So instead of timing basically, we need to try to, or strive to, basically spend more time in the market, right? Then there is another key point we can talk about: trusting an analyst on TV for buy sell calls. So this is like pertaining to a lot of traders, which traders do, and especially in US, they would have find like Reddit and all. Some of the Robinhood guys, they ganged up against this, and ultimately, like, there are the one side institutional investor and other side Robinhood guys, and they were thinking, okay, I will show you down, and ultimately there were some people who lost a lot of money, right? When the dust settled, a lot of people lost the money, right? So all this is like TV influence. But if somebody would have stick to his fundamental, straight away, GameStop is a company and I want to buy it, I look at the valuation, I can say, okay, I value GameStop at only $5 a share or $10 a share, and then it is more than that, I'm not buying. But that share reached like $500, right? So somebody like not able to filter the news, or not able to see the scenario, what is going on, and just the stock is going up, probably buying. So there are a lot of people who made money on GameStop. A lot of retail investors, retail traders made a lot of money on GameStop too, GameStop stock too. But generally, I refrain from that. Okay. And trusting the people who are on TV is like, I in 2008, when I was starting, what did I do? That, like, I had like, I started in like January of 2008, and I started with mutual fund because I thought I don't know anything, right? So that is the safest way and suggested way to start mutual fund. And when I started mutual fund, I can see those were like little turbulent times, that even when the market used to go down, then the mutual fund used to go down, my mutual fund. And then when market used to go up, they either will not go up at same level, or they will sometimes they will even go down. So I was very disturbed with that hey, what this fund manager is doing the right thing, or what he's buying is like, though it is transparent, but I think it is transparency window, I think every 30 days they show what they are doing. So so I started thinking about doing myself, and then I was influenced with the TV, that, oh, this guy comes and says that you buy this, and by evening this will be the target, and you reach the target. So when I started, then I thought that we can make a lot of money very quickly, but the results were not correct. Not that result from that analysis said something else. So I basically, there was a website on that. They have CNBC Awas, CNBC TV 18, ET Now, all these channels. From those channels, they have the analyst, and their call they were throwing in the website. So I recorded their calls for one week. So total, I put more than 400 calls. So they were buy and sell both type of calls. And you will be surprised that less than 50% of the calls directionally right, which means when I say that when analysts say that, okay, you please buy this stock for this target, so the stock went down instead of going up, right? Forget about meeting the target. I'm not saying meeting the target, but directionally also did not do well. Less than 50% is something like 40, 41% it came who were directionally right, 60% got it wrong. And less than 10% of the calls hit the target. So it's so surprising. Like if you think that, oh, those guys are, they are all on meeting target, no, they are not meeting the target. So you can do this exercise. This time probably this would be a little better because the market is upward and most of these guys refrain from giving sell calls. They like to give buy calls. Then maybe these numbers would be better. But so like this 10% may come like 15, 20%, and then this 50%, this can be come like little higher than 50%, right? so so like relying on the TV is not a good thing for a trader. And if you basically I know personally few one of my relative who was doing this exact thing, like trading, looking at the TV and whatever they were saying, and he was making a lot of money for 1 year, and then suddenly he was not making money, and then he lost everything. Like I do not know how it happened, but he had quit the job and was doing 1 year just this thing, and ultimately he lost everything. And then whatever, I think he has 12 lakh rupees or something. So so that is where the learning is. And if you see one thing, that even if a kid, like if I ask him to give a call on a stock and he just spins the coin and says head or tail, and based on that he says buy or sell, even that if he does more than 400 times, he will get 50% time correct. But the analysts of the TV, who are very renowned analysts and great people, they could not get it 50% of the time right, right? So this was the second key point. So this is mainly for the benefits of the long-term investing. This is for one of the basically learnings from my experience. And second is making sense of news and acting
Manish,
to, yeah, yeah. Yes,
Sarah here,
Vala.
right? I mean,
Oh,
in
Sarah,
your
yeah,
Sarah, right?
yeah, Sarah,
In your previous slide,
yeah.
when we look at S&P 500,
Mm,
that's the it's an composite, right? Like 500 companies, and then we are believing the index. Whoever runs the index, right? They are keeping certain persons in the. It's an active index management, right? As a person who buys the
yeah,
index, you are not doing anything, but the guys who are running the
yeah,
index, they are doing some work. And that's one point.
yeah,
The another point is, so there is always this thinking, right? The past may not be the future, and whatever the numbers
yeah,
they show, the how US has developed so long, and
yeah,
now the US is going probably in a different direction. It may not be the same, right? So always people would have this point that you whatever the growth we had wouldn't be the same in the future. So they always make judgments based on that. What is your take on that? I mean, is it like continuing the same path as S&P 500 kind of index? Is that really? Would you stay? I mean, what I'm saying is from 1920 to 2020, right? If you would
mm.
have stayed in 20 years, most of the times, 100% of the time you make money. Would this trend will still continue?
Yeah, I think that the biggest bear market was after 1929 crash, and that was like 20 plus years bear market. Still, people made money in that. S&P made money in that, so that was also positive. So I do not think that now US is going into bear market anytime soon. First of all, And even if they get into the bear market, this would be very, very long bear market. So right now the bull run which is going on is the longest bull run I think US has seen, is like 12 years or 13 years going on still. So definitely what I would say, that I understand your question in terms of return. The returns will moderate now because you're already on higher stage, and then let's say that this is the headroom you have to go, and then you are already here, and then the rate of return automatically comes down, right? So maybe in next 3-4 years we may not make even like 5% to 10% kind of return per year, where in last 1 year we already made, S&P would have made like what, 80-90%, right? So that plateau kind of thing is going to happen. But the benefit of long-term investing is definitely going to stay. And I think another way to read is that read the difference. So let's say that 20 like this 20 years is better than 10 years. That is how we have to read. So let's say that market goes very bad for next 30-40 years, and 20 years become negative. But what you have to think, that it would be less negative than 10 years, right? So here it is the time correlation we have to understand. So if you are daily, you are invested, there is 56% chance only you are making money. But if you're 20 years, 100% chance you're making money. Yes, Siva, you are asking something?
Yes, Manish. I'd
Yeah,
like to add to what you are mentioning. So,
yeah,
whatever the data shown here are
yeah,
taking point-to-point
yeah,
returns, right?
point to point. Yeah,
So, it is something like you invest now and after 10 years, you invest today after 20 years. So,
yeah.
typically, practically, what happens is people invest periodically. So, dollar cost average will be in the favor of long-term investors. So this data is discounting that benefit actually. So
Yes, that's right. So so
practically, to answer
if you
Sarah's
do
question,
SIP, you would still have made a lot of money,
yeah,
right? So this is without taking effect of SIP. It is just like point to point return. So it's like
exactly.
the emphasis of this slide is staying in the market longer. Like don't just take out the money, right? Like 20% up and then you take out the money. That kind of thing, avoid that. If you stick there, then there is very high chance you'll make money.
Yeah, Manish, let's say
Yeah.
once we know that bear market just started, example, do we
Hmm.
still need to continue to invest, or we wait until the bear market completely done, and then once it reverses to bull side, then we start investing? Is it something like that, or we just ignore and just every month we just need to do it?
Yeah,
I mean,
I would love to do it, but if I can do it. So
what
it's
I mean is that we know that this is a bear market and the market will continue to go down for maybe for another 5 to 10 years. I mean, why do we still need to put the money? Just wait until the bear market and fully done, and then once we know the market is started picking up, so from that time onwards we can invest, right? Knowingly, why
yes.
do you want to
So but
invest?
we are not in bear market, right?
No, no, no. I'm asking example. Once we know, do we need to change the strategy of investing, or we can just wait until the bear market to completely done, kind of thing? That
it
time.
it will depend on our style, but normally I would stay invested all the time. That is what I do. And some
Yeah.
people who are very smart people, they take out the money, but then like this thing happened in 2020 when Nifty was at 13,000, and when COVID came, a lot of people start taking out money when it hit 10,000. And between 10,000 to 8,000, when it was going down, a lot of people take out money. And then when the market start rising, they cannot believe, and then they could not have opportunity to invest, so they took out money. Most of the money Indian guys took out at between 10,000 to 8,000, and then they reinvested something around when it passed 10,000 or 12,000. So in 10,000 to 12,000 bracket they reinvested, And again, when the market reach like 13,000 to 14,000, and then, oh man, it is too high, oh man, it cannot, and then they pull out the money, right? So they basically, and now the market is at 18,000. And so in my view, like if they would have not done, just sit quietly, not done anything, they would have made a lot more money than 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 acting a smart work for them, right?
Yeah,
So if
yeah,
somebody can do that, then yeah, for
yeah.
sure.
Especially for market crash or correction, yeah, we can't do anything. We just need to ignore those corrections and all. But especially when we know that we are in a bear market, that's what yeah, that is my point. When we know it is, we are in a bear market, it will go down, it will last for another 10 years. Why do we need to still need to do, I mean, it's a just query only,
No,
because
yeah.
now it's due for correction. People are say, I mean, people are
Mm,
saying that for every 10 years the market
mm,
will change, kind of thing, right? Based on that, I'm saying.
mm, mm. Yeah, but I do not know that we are in bear market, first of all, and then how long we can be in bear market. So same was like, I have seen two bear markets, one in 2008 and one in 2020. Both I did not know when they are going to end. And I was so lucky that I was fully invested in those situations, because when bear market turns around, right, it is so fast and the force is so strong and the things are so cheap, you will not get that kind of opportunity. So 2008 I could not utilize my this thing very well, because like just now you are saying that, I was thinking, oh, bear market will grind for a few more years, and then there was opportunity for me to, I would have invested more money, but I did not and invest enough, right?
Yeah,
And most of the money is made in bear market when the bear market turns around. So like if you see that, if somebody who invested in March last year to June made much more money than from June until now, right? Because the market, when it comes back very strong force, and then the rate of the return there, it's very good. So I think there I would say that the strategy I would like to do, that every 10% down, put your money, and then further goes further down, put more money, and then like increasing stakes helps.
yeah. Okay, Manish. Yeah,
Yeah.
thanks.
Okay.
So Manish,
Yeah.
one more
Yeah.
question, right, in your
Yeah.
same line of thought.
Mm,
So if somebody is waiting to wait for 10% drop
yeah.
to invest, right?
Yeah.
That means indirectly you are keeping some sort of reserve money. You didn't stay that, I mean, you didn't invest it, right? I mean, if I take my example, if let's say I
Yeah.
have, let's say, $5,000 which I'm keeping in waiting for the 10% to drop, that means I'm missing this, like it is just kept idle, right? It's not making
Yes.
any money. Rather, if I just
Yeah.
invest that with my regular say my regular strategy, at least that is
Yeah.
making some money, right? How would you
Yeah.
differentiate, like, keeping certain as a reserve to buy for drop, rather than, that is also let it continue, whatever the strategy you have, continue
Yeah.
investing. How do you make sense of these two, like a reserve money to buy for 10% drop?
Yeah, so that is what I think last time we discussed, that I don't do anything like that. It's like I do not keep money to wait for it. So what I do, I borrow money at that time. So I reserve the capacity of borrowing, and when, let's say, drops is happening, so I will exhaust one option, then further 10% drop another option, further 10% drop another option. So so that is what I do. Normally I am always 100% invested. So some people can say, okay, you can keep 5% cash, so that 5% is cash, is not for investing for something else, but generally that is how I do. But some people who do not want to borrow, then they have to understand, like, okay, so this the 10% opportunity may not come even for 4 years, 5 years, right? In market may not give you, so on 10% you don't make money at all, but on 90% you are making money, right? So just enjoy that 90%, and then so that will basically reduce your rate of return only, right?
Thanks, Manish. The same
Yeah.
line, right? One more
Yeah.
additional question. There are times people
Yeah.
ask me if I have like, generally they talk about like 3 to 6 months is your emergency fund, right?
Yeah.
In terms of personal finance. So
Yeah.
sometimes they ask me, I know myself, I can manage. Do you really want me to keep that 3 to 6 months emergency fund as like a separate liquid cash, or I just stay invested there also during the emergency, right? I will do something, I will manage. Um,
Yeah.
from a personal finance point of view, what would you recommend?
Yeah, I go by managing basically, because the 3 to 6% rule generally it came from US culture, where people are on credit cards and they don't even like, their check comes and then within like they get like, first of all, bi-weekly checks, and then as soon as the check comes it finishes, right? So these people, for them, like that is like they get into a lot of trouble. So from there some of these guidelines come. But people like us, we are very careful as spenders, and then our credit cards are never exhausted, right? Most of our credit cards, we are like within 10% of the limit only, right? So I never paid attention to that thing, like, okay, because I know that somewhere I can manage, whenever time comes, somewhere I can manage that money. So my money just keeps on rotating here and there. I think I told like last time that my accounts will never have more than $1,000 or $2,000, right? But nothing stops. Okay, things just keep moving.
Thanks, Manish.
Yeah.
That was very useful. Thanks.
Yeah. Okay, so moving to the next one. Um,
Okay,
so
Manish,
yeah, yeah,
just in the
time
interest
check.
of time, yeah.
Yeah.
So we were almost nearly 45 minutes. Yeah, just I
Okay.
think people are
Yeah.
enjoying, I think good questions, but let us try to
Okay.
manage the time also.
Sure. Yeah. So this thing is, I think, how to filter news is very important. I think in when we are in a stock market, a lot of news keeps coming. So what I'm giving is some kind of frame. Everybody has some frame of work, but like this thing I learned from one of my mentors in Chevron. There was one concept before that I was using already, but not properly. So like if some news comes, you have to filter like it is important or not important. Not important, just don't bother about it, right? Then once it is important to see, is it relevant or irrelevant. A lot of news which is important may not be relevant to you, right? If it is irrelevant, just stop there. If it is relevant, then you take action or you do not take action. So that decision you have to make, right? So in real life also we have to use this. Like if somebody comes up with some news, you have this filter of importance, second is relevance, and here I put one more in real life, that is it in my control or not in my control, right? So if it is not in my control, I cannot do much, right? And if it is in my control, then what action do I take, right? So in a stock market, because we are passive, we are not in the management of the company and we are not running the company, so everything is not in my control. So I just take away the filter. These three filters we have to analyze the news. So I did a lot of mistakes when I did not read the news properly and take some action, like a stakeholder selling his stock, but did not pay attention. Oh, he's just selling like a 0.1%, or what is the reason for selling the stock, right? So if you look at these kind of news, you will see, you just put in here and see what action you will take on your stock. So this is just like I'm putting this because a lot of people say that they sold the stock very early, and why they sold, because they got some news, right? And what I feel that somewhere they do mistake here, and then they say, okay, probably I need to sell. And some people, they say, oh, probably I need to sell because tomorrow market it will go down, right? Because of this news. Like the company had fire in the plant, the news is important, not important, it's important. Is it relevant or not? Irrelevant. It is relevant. But what action you can take? Will you sell the stock? I don't think so. The reason is because you do not know what insurance the plant has, right? They may get even more insurance money back, right? So since we don't have any information, we have to decide we still want to take action or don't want to take action, right? That kind of thing. US FDA findings in the pharma plant. This is like this one factor brings a lot of volatility on the pharma companies, right? And it just keeps coming for all pharma companies. That's why uh, we have to basically, like, if it comes, then you have to see how much it is and how much, so whether there is impact or not, all those kind of thing, and then you want to buy or sell. So same is with merger and acquisition, very important news, and then it is very relevant, and then probably you have to take action if it is merger and acquisition. But if it is very small merger and acquisition, you can just say it is not important category, right? Like tension on the border, right? Like it is very important, but it is not relevant to your stock maybe, right? So filtering the news is very important to keep staying invested in the stock market. So I hope this framework helps. Then another thing is, this one important concept is position sizing. Sizing to your conviction is very important. Why? For example, in olden days, it is not relevant now, that olden days people used to have a lot more kids than now most of the people have one or two. So this is not relevant now, but olden days, like, one person, if he has 4 kids, what he would do? Father observes the kids since he is born, right? Then he sees the potential of the kids and their inclination. What do they want to do? Do they have potential in that, right? Then fulfill their needs accordingly. Some kids get more demand satisfied in sports, and some kids in studies and so on, right? So in a stock market, like if you have like 5 stocks and you are observing them from 5 years, and if your conviction is increasing, so what does your portfolio need? What is the raw material for your portfolio? The food for the portfolio is putting more money. So allocate more money to the stocks which have more conviction, with where your conviction is growing. And this is one mistake a lot of people do. I used to do, but now I stopped doing, because I see a lot of people just distribute equally, okay, all stocks equally, right? And that is something I don't see even the big investors doing that, right? So a lot of high conviction ideas, we buy the company, and if the management is delivering on expectations, the conviction goes up, so the allocation too should move up, right? So this is this concept is like, there is a guy called Utpal Seth, and he has a 1 hour presentation on that. And I think he explains his conviction on some particular stock, and like how he keep on increasing allocation on that stock. So I'm not saying that if the stock is moving up, no, the performance is based on the operating parameters, and in operating parameters are doing well, allocate more money on that. And if the stock has not moved up, there may be time will come when it will move up very sharply, and then you will get all the return. So it is just very similar. Hunter is finding more footprints of elephant in the jungle. He should spend more time there, right? So if you are getting more and more indications of like management delivering on their promises, it is no brainer. One day the price will also come. Even if the price is not coming, keep increasing your allocation. So I give you my example. There is a company called Hyderabad Industries Limited, HIL. From 2010, I started investing in that. And then 2010 to 13, I bought it from like 500, on an average 500 rupees price. And then the price did not do anything for almost like until last year. And it was staying in 500 to 700 rupees range for almost 10 years. And that was my mistake. The company was doing very well, but I did not increase stake, right? So whatever quantity I had, I just kept it. And within like 6 months in last year, it moved from 550 rupees to like 7,000 rupees or something. So, and now it is still at 4,500. So now I'm thinking, oh man, I should have increased my, when the company was doing very well, the stock was, I was thinking I'm missing something. The company became cheaper and cheaper, like it became like 5 PE, right? And I did not increase the stake. So, and here this quote comes from Warren Buffett, that he says that you will have only 20 punches in your life. That means like he is talking about where you have conviction, punch it hard, right? He is talking about sizing to your conviction when he's saying 20 punches. Then in the stock on which your conviction is increasing, the allocation should increase too. And if the conviction decreases, you should just sell. Like Warren Buffett sell all airlines in just one go. That's it. No, not much thinking there, right? You see, Rakesh Jhunjhunwala has allocated significantly more money in Titan. So his conviction was so high that there was a point, I think he is like 25% plus money was in one stock only. Same is like when Warren Buffett buy Apple, right? It was like significant portion of his portfolio was in Apple, right? And yeah, so Warren, this I already talked. Yeah, I think that's all. We are like 10 minutes still for question and answer.
So thanks, Manish. Let me share the PODV questions.
Oh, okay, yeah.
Can you see the questions?
No, I don't see. I think I'm still sharing my screen. So let me stop share first. Yeah, now I can see that. Yes. So what is the annual rate of return I can expect from equity markets? So yeah, I think now in India it is 15% to 17, 18% you can expect. In US market 10 to 12%. Then what is the second question? What is the key difference between investor and trader? Which is better for making money? So yeah, so for making recurring money, very clearly trader is better. But creating very big wealth, investor is the only way. I don't see any. Like there are some traders, very few, who would have created a lot of money, and trading is like a skill game, and you have to spend time also, right? So yeah, clearly investing for creating big long-term wealth. So what is the next is, can I invest in commodities for long term for better returns than equity? Yes, I think commodity, yes, you can invest money, but it generally you need significant money to make money in commodity. For retail investor, if they go ETF route, then there is a cost you have to pay, that is called tracking. You have to see tracking error. So even if, let's say, you invest in oil ETF, oil can make money, but oil ETF may not make that much money, right? And in fact, you can even lose money there. So very careful. Commodity is much harder to make money than equity. Yeah, and then this one is interesting one. My brokerage gives me a lot of solid recommendations. Most of them were good for me. I am making a decent return. Why should I bother what type of investor I am, and so on? So this is very good question. So this question I also had in my mind, and I think that the good thing is in investing is there are no rules, right? If you are making money, then it works for you. Just keep doing it, right? but just be careful about accounting for the money, and like knowing where you are actually. You may be thinking you are making much more money, but how much you would have made, right? Like for example, following the recommendation most of the time will land up with you with market returns. And did you have potential to outperform? Yes, if you had potential to outperform, then you would have made more money, right? So it is something very similar, some people do food delivery, food supply, like you can get lunch every day from them, and it basically is cheaper also, because cooking food at home, even cost is higher, because you cook only for 2-3 people, they cook for 200 people, and if they don't charge you enough premium, then probably you will get it for a cheaper price. And then you spend a lot of time also, so time and money both you invest and still cook at home, where probably if you eat outside food every day, you can save time and money, but still people cook. So the reason is because we do not know what the cook is doing, right? Is he using the used oil again and again? Is he giving you fresh money or not, fresh food or not? All these things, if we do not know, that for that reason we still cook at home. So think about that. When the brokerage is recommending some stock, are they paid to basically recommend some stock? Are they giving you right information, right? For example, if I remember correctly, there was I know one of my friend who works as an analyst in Motilal Oswal, and he did a stock recommendation for like 30%, like a stock was like 100, and he was saying, oh, it's 130 is the price target. I called him and I told him, okay, so when I look at the stock, the value of a stock is coming like 500 to 550, something around that. And then I told him the reason, and he agreed with all my reason, and he said that he himself valued the company at around 400 something. Then I said, but why you are giving the target to 130 only? He said, because my brokerage doesn't allow me to put more than 30%. I do not know how much true. I think at the time he was not with Motilal Oswal, he was with some other company. But brokerage had restriction on not putting his view. Brokerage has some view on the stock already, and he has to fulfill that. So some brokerage can straight away come, okay, there is a sell rating on this one. So none of their analysts, even if their personal portfolio, they are buying the stock, but they cannot buy because the brokerage, they cannot give recommendation to buy because the brokerage has sell rating.
Yeah, Manish, can I add
Yeah.
something to this?
Yeah.
What you are saying is true. What I know is even though their valuation comes, let's say 200 times or 300 times, they don't want to give. In the first place, the target audience or the majority of people who really are very satisfied with 15 to 20% per annum. So they will try to give that number. And when they big brokerage houses, they do their own internal audits and produce these reports. So this is the n number of times that we have done recommendations, and this is how we have succeeded. So they don't want to give a 400% target, let's say in 2 years time or whatever. They can't give a duration also, right? So they don't give a 400% or 300%. Then if it doesn't meet, right, let's say the stock goes only 150, then they may lose even the internal audit. So they want to always play safe and give certain range like 12%, 15% in 6 months or 20% in 1 year. Then they will also try to play with these numbers to make their audit results good. And a lot of big or so-called the top brokerage houses, right? If you see their internal audits, you really want to believe it. I mean, it's really very compelling to invest. They have 90% accuracy.
90% accuracy, and if they give a smaller target, very quickly they can achieve it.
Exactly.
Right?
That is how they
Right?
play with this number. And
Yeah, they play.
for the past 1.5 years, like you said, any Tom, Dick, and Harry can give any buy calls, and we can see that more than 95% or even 98% are buy calls only. So anyone can
Yeah.
give at this moment.
Okay. Yeah. So that's true. And then yeah, thank you, Siva. I totally agree with that. So what you are losing, try to track that. Okay. So you may be making money, but are you making more money more than market is making? Because then you can just invest in ETF and make money, right? And then how much more you are making, or what was the potential, right? So, and then my analogy, bookworm, bird hunter, and wild hunter is very, the analogy is very good. How critical is reading annual reports prior to buying or after buying a stock? Yeah, so I think very critical to read annual report, and not only one, try to read like 5 or 10, but most of these annual reports are more than 100 pages, right? So you cannot read all 100 pages, but I would say read at least a balance sheet, cash flow, and management discussion analysis, right? So I try to do that as much as possible. And there was a time when I was not buying unless I do that. So I learned my lesson, because by the time I finish, it takes like 3-4 weeks, and sometimes the stock can even double, right? There was a stock called RPG Sciences. I started monitoring at 120, 130 rupees. And then by the time I finished reading the annual book, the stock was already at 280, right? So it's like we got to be like try to prioritize that. So now what I do, I basically go and just buy very small amount, something like a less than 0.5% of my portfolio, just looking at the first screenshot of the stock, and then prioritize, and within like a certain time I want to finish this thing, right? And then what is that? Where did you place the index investor in your analogy of bookworm with hunter? Yeah, so index investor will go in the institutional side, because they are taking the institutional route of the fund manager, right? So because they themselves are not investing, they are just giving their money to somebody, and then whatever psychological or temperament thing, it is the fund manager using that. Then the analogy of is how critical, okay, that we have done. Most of the analysts saying based on the past data, how stocks rate increase, how do we pick up low rate stock and for long time? I don't, what does low rate mean? I do not understand that. Okay, so I think probably the stock which have not given a lot of return, maybe that is what they are asking. We will have to look at that company. If somebody has not given good return, then why they have not. Some YouTubers post videos on past day Nifty and trying to predict the for next day based on technical analysis. Any suggestion if they are worth trusting? No, they are not worth trusting at all. It means like making money is not so easy, right? It is simple, but not very easy. So most of these guys, what do you do, whether they are worth looking or not, or like you observe them for 2 weeks and then see what their result came, right? So just like what I did, I put 400 calls, and then the results were very, very clear. Yeah. So I think in the chat box also some people put something. Yes, let me see.
Yeah, Manish, there's two questions in the chat box.
Well, I have already put that in that same question. I mean, the whole EV, you can refresh the page.
Okay.
Just.
Yeah, so put the newer one. Okay.
Bala, I think you may need to refresh, Bala.
Yeah. Okay. New. Click on the new. Yeah.
Yeah.
Okay. How your short-term list stocks from 5,000 companies, even HIL not heard from anyone recommendation. Yeah, the HIL will never come because it is a very big, very good value pick actually. So what I do, I use a screener. I think Siva also uses a screener, I want to do next session on how I filter the stocks and what are the things I look, and then how I arrive. So that would be like valuing the stock class, and we can do. But generally, I would say that go to the screener, put your filters, and you can filter. So filter your stocks. But for that, you have to first thing you have to know that what is that called, um, model of the company, cash flow, how the operating model of the company, right? Then you know how the company makes money, right? Then you can select parameters, and then you can come up with the stocks, right? Most of the people put like P, and cheapest stock come on the P, and then but why they are cheap also we have to know, right? So
Yes,
that,
Manish, sorry.
yeah.
Yeah,
Mm,
this is very interesting, and a lot of people are interested about how people are really choosing stocks. So
mm.
probably what I can suggest in Balam group, we can ask for volunteers to talk about this topic, and we can have how people really screen their stocks. We can have something like a forum, not like a talk. So we can share how really individuals pick stocks. Will that be worth considering that?
Yes,
Yeah,
sir,
yeah.
we're hearing a lot of noise from backside.
Mm, mm. Yeah, yeah, I think that should be useful. We can do that. I would be happy to basically share how I do, and some other people can chip in. Everybody would be doing something differently, but what I like to do is basically, without looking at the price of the company, looking at all the operating parameters, and from there I value how much the company is worth, right? and uh, and then I see the stock price, how it is matching. Then I see how it is matching to the competitor. Are there competitors who are even cheaper and doing even better, right? So then I can make the decision. So the stock market return is measured based on the limited number of stocks, say Nifty or Sensex, etc. Is there any data available, how broadly the market performed based on all the active stocks? Yes, I think there is data available. You'll have to search how the overall stock market grew in India. But what happens in that, the number of companies also keep on adding. So basically, the returns is difficult to identify that. Where in Sensex, the 30 companies are fixed, and then those companies how they are moving, then you can get the result. So I think Nifty, if you see BSE mid cap and a small cap, I think you can get 20-year data on that at least. Most of the analysts saying based on the okay, so this one we check some YouTuber. Okay, yeah, I think we are done here, right? Oh, there are something on top. Can we go up?
That's all, Manish. Those
That's all.
questions we already answered.
Yeah. Thank you. Yeah,
Okay, Manish.
yeah,
Thanks a
we are
lot.
on
So,
we are on time. Yeah.
yeah, we are 10 minutes beyond, but that's okay. It's very interesting. So maybe before we close, is there any pressing? So one more question came. Do you want to attempt this?
Yeah, mostly in trading on discount. Yeah, holding company have to trade on discount, and sometimes the discount is very huge, uh, and it should not be. Generally, I think holding company discount should not be more than 30%, but the market is giving opportunity. A lot of holding companies are trading like 90% discount, and these are very good companies. So why they I think trade on discount, the reason is because holding companies are not like operating companies, right? They are there for a different purpose. They are made for basically share the shareholder, the promoter interest. So who creates the holding company? Like a Bajaj guy, he has Bajaj Auto, he has Bajaj Finance, Bajaj Finserv, but Bajaj family want to invest, so they create a holding company, and through that they invest in these companies, and these companies hold this. So holding company always will protect the promoter, and that is the purpose of the holding company. If something happens to these companies, nobody can touch my money, that kind of thing. So they are less honest for minority shareholders, right? So that is the reason there should be discount, but should that be like 90%, 80% discount? I don't agree with that. So that is why it is a value there. And so value pickers always go and pick holding company. I always pick that. And basically I'm not very happy with because it is not making money. Because if I would have invested in the direct companies, like my biggest holding is Godrej Industries, and Industries has Godrej Properties. So I have some investment in Godrej Properties too, but Godrej Properties has become like in same period like a 12x or 13x, where this one has not given even 2.5x, right? So I hope it will basically become better after some time, but not necessary. So, but it's still like I have to stick to my principle of value investing. So in my view, like Godrej Industry is currently at 80% discount to what it has in it. Yeah, Wala, you
Okay.
can go on.
Thanks a lot, Manish. I think thanks for your valuable time and sharing your experience, and then preparing the slide contents and everything also. It's very really wonderful. And I can see the energy level with the participants also putting questions in the poll EV and chat box and everything. And I sense like a lot of them want to ask questions directly live. Maybe after this, they can respond on the survey and then see whether the time is, previously we did like 2.5 hours.
Yeah.
Now we try to do it with 1 hour, but I just exceeded like 15 minutes.
Yeah.
And maybe, continuously we can just improve this session in terms of time management and content and maybe asking questions. Thanks.
Yeah, I think what you can do next time, probably without any session, just put poll EV questions and then have like people answer, like, and people chip in. That is also another idea. If people are interested in question, just collect question over a week. Let's say there are like 30-40 questions, ask everybody to vote, and then probably assign the answers to some people within the group. Assign the people who will answer.
Yes, Manish, that's a wonderful idea. I think that we'll put that in the one group and we'll have just one Q&A session.
Yeah, just question answer should be good enough. Yeah, because a lot of people have a lot of thing in mind, and then by slide we have to divert them on one side, but they will still ask the question what they have there in mind. So let's flush the questions away, and then that will basically let us know where the interest is also, and then so that we can create the future content.
Sure, thanks, Manish. Based on the energy level, we strongly consider the Q&A for the next session.
Yeah, thank you.
So thanks a lot, Manish, Siva, and others of participating in this, and then making the session very lively. Thanks a lot. Bye-bye.
Yeah, thank you, everybody.
Bye.
Thank you. Yeah, okay, bye.
Good morning, sir. Mike. Thank you, Bala. Thank you, Shiva, sir.
Okay, bye.
Thanks,
Thank you, Bala. Thank you, Manish.
Thank you, everybody. Yeah.
Thank you all.
Thank you, Manish.
Thank you, Prem. Yeah.
Thank you, Manish, and thanks for the team.
Yeah, thank you, Sarna. Yeah.
Thank you, Manish sir. Thank you, Siva sir. Today I asked my daughter Bhuvanasri. She is 18 years old only, but she is very much interested in stock market. So he's really enjoyed your session, and also she is able to grab so many new things. Thanks for your session, sir.
Oh, wonderful. Thank you. Yeah, it's good that younger people are joining.
Oh, sorry, Mano, who is that speaking?
Sorry, Siva sir.
Mano, who is that? Can you recognize yourself?
No, sorry, Madhusudan here.
Oh, Madhusudan.
Sorry, I think my daughter name was there. Sorry, Bhuvana is.
Oh, Bona. Oh, okay. All right, okay, fine. Thanks. Yeah, that is why I was looking. Okay.
Okay.
Okay. So,
Yeah, yeah.
oh,
Yeah.
good. Right.
Okay.
Great, great, great.
Yeah. Good is that younger people are getting involved. And I think if she starts at 18, she will make much more money than all people here combined, you know.
Yeah. Last 1 year and all, he will always ask to give, please give some landings on stock market and all. But now only she completed school and all. I told that now it is the time to start. She already opened a gift account and start investing in IPO and all. Let's see.
And girls are financially more skillful than guys. So that is even better. I see a lot of good fund managers are ladies now.
Okay.
Great to see Gona here. Oh, Gona, from Tesla. Hi.
Yeah.
Thanks, Shiva sir.
Good.
Okay, thank you guys. So I will also leave now and I catch up with you later.
Okay,
Thank you, Manish.
Thank you.
Thank you.
Yes,
Yeah.
Bala, you
Okay.
can
Bye.
close the chat.